Thanks everyone for being here. And this will be recorded. I know many of you said you couldn't make it at this exact time, so our intention is to do this one live and then send out the link. So we're really happy to have you here, particularly in these volatile times. We are, as portfolio managers, monitoring all of the news and all of the trends and making some really interesting picks, we feel, for our portfolios as we construct them. So we have a front row view into what is happening, and we'll spend some time this morning or this afternoon for some of you, just sharing what we're seeing, what we believe investors need to know, and some of the interesting and compelling trends that we're looking at. So let's go to the next slide where show you who I am joined by today, our awesome portfolio team. We have two members, Jethro and Samporna, and we are joined by our most recent equity analyst, Christian, who will be listening in and who did help prepare some of our research for today. So we'll move right in. And I'll just start out with a little bit of a brief overview, and then we will move to Samporna and Jethro, and then we'll wrap up, and we're available for any questions. Paloma may have said this already to add them to the chat, or we'll be taking questions at the end. Starting here with disclosures, oftentimes asset managers and RIAs put them at the end in really tiny print. This print is pretty small, and yet basically it is that we are sharing trends. We're not making investment advice on this call, and that though please call us, and these are all available on our website as well. We have a second page of disclosures. We can go to that. And it shares a little bit more about our firm, about our philosophy, and then about risks of investing, and that no investments are guaranteed. And I feel good about inviting you, with that being said, into what we have to say next. So let's go to our next slide. And excited to start out with a little bit of the dialogue as far as, can ESG investing work, and can you actually invest to do good and do well, and can you make money? And particularly during these times, we are proud to share that this is our flagship portfolio, NIA Global Solutions. And while many portfolios we're seeing and hearing about are down, we actually have had some nice returns this year, and we'll go directly to our next portfolio. Oh, let me just, before we move to the next slide, just say that in this case, we have compared the performance to the MSCI ACWI IMI, which is the MSCI, and that is a global index, and it is at any given time has about 2,000 companies in it. Cap size agnostic, goes around the globe, and so it's not a perfect comparison, and yet we don't have a lot of comparisons for our own work. So showing that because it is an industry standard. And of course, at NIA, we're looking to be really different. And NIA means intention and purpose. And we are investing with intention and purpose into the economy that we want to see, and proud to show that it can work. It can work. So let's go to the next slide briefly, which is one of my favorite portfolios we run, the NIA Growth and Dividend. And the name shares a little bit what it is. We're looking at companies that are poised for growth, that also provide regular current income via their dividends. So what we love about this portfolio, very similar in construction, in that we are starting with the revenues of a company and how it is baked. So we're looking across our 6 solution themes, and we are investing for sustainable planet, for healthcare, for natural and organic foods, healthy soils, healthy people, transportation, and communications. And pleased to say that, thus far this year, and this is based on a model portfolio, so these aren't our composites. So it just gives you a snapshot that yes, you can do well by doing good, and vice versa. You can do good by doing well. And the proof is in the numbers, and we're happy to share that. So let's just go. We have a couple quick slides on the long-term performance as well. So let's just move to those, and we're happy to send these slides out to anyone that is interested. These are through April, and so, but basically showing in the case of NIA Global Solutions, we will be celebrating our 10-year track record at the end of this year. Really proud of benchmark beating, index beating portfolio, doing the work that we've been doing since inception. And then I believe the top one is our NIA growth and dividend, and then the bottom one is the NIA Global Solutions. And so just one is our flagship, which is the bottom one that I referred to that has a 10-year track record. Then the other one is a little bit newer, having launched in 2018. 29. Anyway, so and happy to share more about that, but just really wanting to as we move into what are the points, what are we watching? What we are watching is both standard and yet really unique at the same time. And we are looking at due diligence across the E, the S, and the G, the environment, social, and governance. And we're going to be sharing today more trends about that. And just why does it matter? Because you can actually outperform the market by looking at some of these things. So let's just go into that. And again, I'll do the high level, and then both Jethro and Sampurna will jump in. So one of the points that I feel like hasn't been covered in the news enough is that we actually are, regardless of what is emanating from the White House or talk there, we really are, as a globe, transitioning to renewable energy, and we're looking at more sources there. And a lot of this came up originally in the 1970s when there were global trade wars, and there was those of you who were around then, I was sitting in the back seat of a station wagon while we were waiting our turn when gas was sanctioned. And there were such issues in the US that the US actually started looking at alternative ways to provide energy. And that happened around the globe in the 70s. And I mention it because 40, 50 years later, we are actually at a very similar point in history as far as the geopolitical situation. And in Europe, Europe as a whole, as a voting pack, wants to have more energy independence from Russia. And they have been putting money, time and attention and actual real dollars into developing and getting off the grid. And we're talking about their solar, wind, and waves. And so I think that's exciting news, particularly for our renewable energy companies, despite the rhetoric in the US. And then just something else I wanted to say about the US is that in March, we didn't see this enough in the headlines. The US had the month of March where energy demands were met more than 50% by renewables and less than 50% by fossil fuels. So that marks a turning point. And, can we do that again? Yes. And does it depend on conditions? Yes. Did we have additional sun and then additional wind during those times? Yes. And yet we're going to have more sun and more wind in our future. And it shows the demand, and it shows also the need for more infrastructure because the world really does want that. And so we're not showing this slide this time, though I've shown it in the past about just energy consumption and then also pricing. And so thinking about that, gas is a commodity, oil and gas and fossil fuels are generally commodities, and prices of commodities fluctuate and they go up and down, and it depends on global demand, and it depends on largely price of extraction and getting refineries and all of that, and then getting it to market. Whereas for renewables, the prices started out high when the technology was really difficult and cumbersome, and yet the prices generally of technology comes down over time. And whereas wind and the inputs like solar and wind, those continue, whereas the cost of the technology comes down. So we are looking at that intersection with the demand for these technologies increasing and the prices coming down. So we're excited about that. So let's go to the next one. So this is another trend that we're seeing, and I'm sure you all are seeing it because this one actually has made the news, which is that brands and corporate leadership across corporate America do matter to consumers. And we've seen just a few examples. Many of you have followed our work at Tesla, where the lack of governance has been pretty influential in the share price. And while that's actually a meme stock that doesn't actually react as much to governance, as it could or should. There's definitely been damage to the brand, and we're seeing that in the sales numbers. Both California and across Europe had been very Tesla heavy, and they had been leading there, and those numbers are dropping, and other competitors are moving in, and the brand has definitely been damaged across many of the consumers of Tesla, and they're seeing that, and it's a problem for that company. And then just jump to another one that has also been in the news. And we're seeing earnings reports reflect some of this, is that Target, another consumer brand that was basically for many, many consumers a staple as far as a weekly, if not more than weekly, everywhere from groceries to school supplies to auto parts, everything was being purchased at Target. They specifically walked away from many of their DEI, their diversity, equity, and inclusion programming, and also their stance there. And if you've been in a Target lately, you will see that the aisles are almost empty. Consumers really have started a boycott, and it has been reflected in their numbers. Another concern for us, and why we had been interested in that company in the beginning, was they actually had a pledge and a commitment to Black and Brown entrepreneurs, and you would see Black and Brown entrepreneurs represented in the branding on the shelves, in addition to the hiring promotion of people from Black and Brown communities, and their walking away from DEI has actually hurt their brand and their bottom line. On the flip side, we're seeing Costco do the opposite. They're doubling down, and I actually was in Costco on Saturday, and it was a zoo. It was, you couldn't navigate anywhere because everybody is at Costco. And so just a couple name brands there where we're seeing that, and we're seeing that across the industry, across industries, that it really does matter. And particularly in volatile times, we saw this during the pandemic and the previous administration, when business models needed to shift and pivot, both due to the pandemic, also due to what was then a border crisis slash tariff situation. Of course, we're seeing that in spades now. And what companies need, despite all of the attention and rhetoric and headlines about AI, and we will get into AI and what those trends are as well. Companies really need loyal employees. They need employees that can feel that they can bring their full selves, that they can roll up their sleeves, that they can get to work and address the issues, that they can feel valued for their contributions. And many of the diversity, equity, and inclusion programming that companies do allow employees to feel that. They also can be attracting, retaining, promoting top talent. And particularly for the NIA companies, though I would say this across the economy, we're really counting on companies to keep their innovation, especially during these times when we might need to see pivots, when we're looking at suppliers needing to change based on tariffs, whether we're looking at onshoring and bringing more fabrication to the US, or maybe it's trading partners, literally trading trade partners as far as where companies are going to sell. We're needing lots of innovation, and we're needing lots of teamwork to get through this type of situation when there's geopolitical, and then especially with our own internal, I'll just call it chaos, to navigate. The DEI programming really does help, and it stands out, and we're noticing that both in our companies and then across the globe as well. Let's go to the next one. Green data centers are needed more than ever. So this is something that we look at particularly, and this is as we're seeing the proliferation just across the board, across the economy. You know, we have the tech sector, and yet we do see AI being utilized for good oftentimes, and for questionable times, and we're seeing it across the economy. What I feel like isn't in the news enough, and that we want to see, is both the energy consumption as well as some of the bias that's happening with the adoption of AI. We actually had a call with one of our companies yesterday that is using AI in insurance. And one of the great things that AI can do, obviously, is automate, and it can increase speeds. So particularly if you are a consumer of insurance and you have had a home break-in, or you have had a car issue, or any type of insurance you might need, you definitely want a quick reply, and that takes the the pain level out of any situation you might be going for when you're going to be reimbursed more quickly. And yet, the question is, given that AI models are built on our current economy and our current web, which is already biased, is AI going to be biasing? And what is that going to look like, both for consumers and for companies? So that's something we're really watching, and it's something that we're talking to our companies about actively. The other piece we're really paying attention to, and I think we'll see more of this in the news, is the energy consumption. AI does take so much more energy, and because the data centers are quite hot, and they're also putting them oftentimes in places that have low populations like Arizona that are already very, very hot, then they're actually needing more water in the cooling processes. And so the consumption and the energy, as far as the environmental effects, are something that we're watching. And so as AI becomes more and more popular, from our own searches at home on our laptops all the way to, cell phones across the globe, and then company usage for so many different criteria, we're going to need many, many more green data centers and really energy efficient ways to think about this. So that's just another thing we're seeing. Let's go to the next one. And this is a little bit in some of my previous points. Addressing climate risk is both essential and it's now required. And so many of you are saying, what do you mean it's required? They've rolled back so much in the US. And so what's kind of exciting is that Europe still has requirements. And we are seeing, and we have seen, particularly since we started these strategies, say 12 or more years ago, one of the criteria that we had in looking at companies is they had to have some nod to being sustainable on their websites. And that was really important because we needed to know that we were investing in companies that had commitments to sustainability. Well, if you go on any website now, you will literally see the greening up, like the color green. You will see plants on most websites, and you will see some sort of commitment to sustainability or the environment on almost every website. So that's no longer a criteria at NIA, because what we're seeing is both actual commitments, and we're seeing quite a bit of greenwashing. And so that's been just an interesting trend to note, where we're going to see it play out in investment thesis and portfolios moving forward, is that the greenwashing isn't going to be as effective anymore, because we ask companies to report on their scope 1, 2, and 3 emissions. We're also wanting to know about what are they doing to prevent climate crises, and then more probably importantly across the economy and across all portfolios, is what are companies doing to both mitigate their own risks. And so having some of these numbers in place is going to be really important as far as their own internal audits. Also looking forward to circular economy plays. So instead of getting rid of a waste product, could it be used somewhere else in part of their process, or could it be used by a neighboring company where one company's waste product could be an input for something else for another criteria? So looking at circular economy that really ends up being much more efficient for companies. So we're watching for that. And then again, with European requirements for reporting, some of this greenwashing is not going to be effective anymore, because the proof is going to actually be in the pudding about which companies, based on locations and then based on weather patterns, and how are they doing as far as dealing with some of the climate crises that we're seeing. And of course, at NIA, we're investing in the very solutions to the climate crisis. So we're looking at infrastructures, and of course, we're seeing geopolitically that we're going to be needed more and more. So that's something that I'll be looking forward to sharing. Let's go to the next slide. These are what I've mentioned previously, and I think many of you have seen them in the past. This is what we base all of our work on. And so this is the core to our investment thesis. So we are looking to address what is needed for people and planet across these 6 solution themes. And this is where we are really seeing the opportunities. And again, my colleagues will go deeper into what are the opportunities that they're seeing. So during these times, particularly with the political environment, and then also with the trade wars and the climate crisis, where are we seeing the opportunities across these 6 solution themes? And what is exciting for us at NIA is that not only are these what are needed for people and planet to survive and to thrive together, they are also places that the market will reward for. So excited for that. I'm going to transition over to Sampurna, who will take this to our next part of our webinar.
Thank you so much, Kristen. So I would like to begin by setting context for the next few slides with this particular one on the GDP percentage change that we saw recently. GDP is our gross domestic product. This bar chart shows us the change in the gross domestic product number at an annual rate as of 2025 Q1, where we saw a contraction of 3% or a negative 3% change in GDP at an annual rate. There are a few insights that we can glean from this bar chart and specifically from the different components of the GDP. What makes up the GDP, as we can see on the slide, are personal consumption expenditure, private investments, net exports, and then government consumption and expenditure. We can see that both net exports and government expenditure declined compared to the previous quarter, which is Q4 of 2024. With net exports, as we've all seen with the kind of tariff uncertainty that's been prevailing, a lot of companies were trying to prepare ahead of these incoming tariffs by ordering in or stocking up on inventory earlier than they normally would have. The net exports component is calculated by subtracting total imports from exports, which caused this decline in this particular quarter. And then for government expenditure and consumption, we've also seen that there has been a reduction in budgets and contracts across several federal departments. We've seen that in the headlines around DOGE, and that led to the decline in this number. But what we are specifically interested in is the gross private domestic investment, the sharp spike that we've seen in what is essentially investment in fixed infrastructure. This is not new to this particular administration. This focus on onshoring manufacturing capacity to the US began with the previous administration, and the focus on that has been amplified through, of course, the tariff policy and other policies of this current administration. Now, all of this is happening parallelly to the continued massive global adoption of generative AI. Countries and companies are competing to stay ahead of the technological curve, and the massive amount of power and infrastructure that is needed to support this transition is also contributing to this rise in fixed infrastructure. This corresponds to what we're seeing in our holdings, where we're seeing pretty robust backlogs within our industrials, our utilities holdings, which are focusing on green infrastructure, updating and maintenance of the power grid. As Kristen mentioned, in terms of the water requirements for data centers, water supply and conservation infrastructure, all of this is something that we're seeing in our holdings as well. I would like to focus in on one specific part of this infrastructure investment, which is on data centers, which is something that Kristen mentioned. So this next slide shows us current and estimated trajectory for data center power demand over the next few years. As of 2024, data centers consumed 1.5% of the total power consumed in the world, of which the US was the largest consumer, followed by China, followed by Europe. And that was around 415 terawatts, which is what we can see in this line chart. And this demand by power centers is set to exponentially grow over the next few years. A question that we get asked sometimes is that against this backdrop of increasing demand for power, particularly with the context of power centers, we stay out of the energy sector as defined by GICS, which is the Global Industry Classification Standard. So the energy sector constitutes of traditional oil and gas. And by virtue of us addressing our solution themes, we stay out of oil and gas. A question that we get asked is how viable it is financially to stay out of oil and gas at a time like this when we see the power demand rising exponentially. And here is where lies our answer. So we can see this is the total power capacity in gigawatts over the last few years. And we can also see it broken down by the type of power, which includes coal, natural gas, as well as different forms of clean energy. We can clearly see that both natural gas and coal have been declining as a share of total plant capacity, whereas renewable energy has been expanding. I think Kristen mentioned this in her introductory notes as well, is that last year, of the total new installed power capacity, renewable accounted for more than 90% of new installed power capacity. So given the data center power demand set to exponentially increase, renewables hold a great deal of potential in addressing this increasing power demand, particularly because they are cheaper to provide than these traditional forms of power. The levelized cost of electricity is lower. And we have seen this in our international markets for renewable energy, where we've seen this sustained and robust uptick in demand, even though there are currently some regulatory headwinds in the US, particularly with permitting around wind, as well as with a withdrawal of some of the IRA tax incentives. So if we have given NIA's thesis since inception, we have spotted and invested in this infrastructure that would support this transition to a sustainable economy. And we have seen our holdings benefit from these trends over the last couple of years, in fact, and particularly over the last few months as they have amplified. And we continue to expect to see these in the remainder of the year. An additional nuance to this performance is that in the past few months, and could we move to the next slide, please, for this next point? In the past few months, there has also been a lot of volatility around crude Brent oil prices. This has been due to various reasons, both in terms of a weakening in demand for Brent oil, as well as the OPEC, which is the Organization of Petroleum Exporting Countries, voluntarily increasing supply in order to drop the price of crude oil, which has led to a significant amount of volatility. On this chart, we can see the performance since January of this year of NIA Global Solutions, which is our flagship portfolio, as measured against the BNO ETF, which measures and tracks spot prices of crude Brent oil. And we can clearly see the difference in performance, particularly in the last few months with the kind of volatility that we've seen around these oil prices. So not being in this sector of traditional oil and gas has greatly benefited us in the last few months, and we expect to continue to see that in the next few months as well. On that note, I would like to hand it over to my colleague Jethro.
Yes, thanks, Samparna. Thank you very much. Healthcare is another one of our key solutions themes that we're focusing on here at NIA. And as many of you know, many facets of healthcare are facing things like reimbursement and regulatory challenges. We're focusing particularly on critical care companies that are, for example, more defensive and relatively more policy resilient. And have more consistent demand and margin resilience in this highly volatile environment that's sort of constantly in a state of flux from a regulatory perspective. We're also seeing opportunities in healthcare and machine learning and AI-driven innovation within the space, particularly companies that are harnessing AI and data science to, for example, enhance diagnosis and early detection of certain diseases, particularly diseases such as epilepsy, autism, and certain types of cancer that are leading to really better outcomes, lower costs, and more effective overall treatments within healthcare. We're particularly interested in those companies that have strong intellectual property, as well as companies that have collaborative partnerships in the space. Another area that we're focusing on is in alternative education, where we're focusing and investing in those companies in particular that have really scalable education technology platforms that are, for example, addressing the global upskilling and reskilling of workers, and also companies that are, for example, developing language learning applications. As another example, overall in that space, we're basically focusing on companies that have strong fundamentals that are really being driven by those who are seeking alternatives to the current educational system. Another area that we've been focusing on here at NIA, which fits under the Thriving Community Solutions theme, is in cybersecurity. As sure as many of you know, we're seeing an increasing number of cyber attacks in various sectors and industries. I'll point out in particular that where they're highest, we're seeing attacks in areas such as higher education, government, healthcare, a lot of our critical infrastructure. Like these are, seeing year on year some of the highest percentage increases in cyber attacks. It's also largely, for this reason that we think that this sector is going to continue to be pretty resilient even in this environment. As you can see in the chart here, that the percentage of cybersecurity spending as a percentage of overall IT budgets has doubled over the last 10 years. And we expect that to remain pretty resilient going forward, given the aforementioned, as well as what we're seeing with the advent of artificial intelligence and more advanced algorithms, which makes it really more challenging to defend infrastructure in that space. Another thing that we're looking out and watching for, which is in the nascent stages, but the advent of quantum computing, which is still early innings, but that will pose another significant challenge to a lot of areas within the space. Yeah, just briefly, and I'll wrap up. Just taking a bird's eye view of the portfolio, just sort of zooming out, if you will, in terms of how the portfolio is positioning by sector in terms of overweight and underweight relative to the benchmark that Kristen had discussed earlier. We have a bit of what we like, call a barbell approach in terms of positioning. Where within the portfolio, we have overweights in what has historically been more defensive in healthcare, for example, while at the same time we have exposure to some of the higher growth, more pro-cyclical industries such as information technology and industrials. And if we were to sort of further peek underneath the hood in each one of those sectors, for example, in information technology, which a lot of our investments that fall under the Thriving Communities umbrella are housed, if you will, in terms of our cloud software and cybersecurity investments. In communications, we're investing in some of the streaming companies that have more inclusive programming initiatives in place. Samperna has talked already a lot about industrials in our exposure in data center infrastructure, electrification, even also some of the solar names that we own, which are increasingly under policy threats. We've been investing in some of the more domestically oriented solar companies with stronger balance sheets. That a couple of them have significantly outperformed this year. In financials, we're playing the democratization of access theme in fintech. And while we're neutral in staples, we've been overweight in natural and organic foods, which has done well for the portfolios. And then lastly, in energy, we have a zero position there, particularly because of no exposure to the oil patches Samperna had discussed, which obviously doesn't fit within our solutions themes and our goals of investing in a more sustainable economy. And on that note, I'll pass it over to Kristen.
Thank you so much, Jethro. And also thank you for going over that chart. Just to expand on what Jethro is saying is that, we do see, we're looking at this across the big sectors, the way Bloomberg has divided the economy. And then as you could see from that slide, we're also looking across the aspects of the economy that really are needed for people and planet. And those are our solution themes. And then woven throughout all of this that we haven't mentioned too much is a commitment to the diversity, equity, and inclusion. So all of the companies that we are looking at have women and oftentimes people of color in leadership. And we're actually seeing that in the returns. We're seeing that that is a contributor to Alpha. So we will continue working on those. And then in our next webinars coming up over the summer and then into the fall, we're going to be going into some of the other criteria that we are looking at and then also talking to our company. So I'll just give a quick highlight in that we are looking for second chance hiring programs, and meaning that rather than using prison labor as in a, and some companies do that, we're actively looking across companies and then having them not use prison labor and use as people are getting out of prison and out of what in this country is called the justice system. I would say it's not just. And how can corporations play a role in really incorporating some top talent that may or may not have a college degree, and do they need to have that for a lot of these jobs? So looking at those types of things, and then also looking at political spending of our companies. And so we'll just highlights of things that we'll be looking at as far as more trends that are going to be important throughout the year. And then this last slide just lets you know where the two portfolios that we did talk about are available. And what's interesting, I think, about this is that really our entire economy happens based on investor request or demand. And so we do get the economy we invest into. Investors also have a huge role to play in what products are available. And so many of the places that we are available is because one of you requested us there and said, we want NIA to be part of our portfolio at one of these places. And so I mentioned that because the power that each one of you has to request the portfolios and the products that you want in your own portfolios in your 401ks and your retirement plans are on custodians, it makes a really big difference. So if you custody at one of these places where we're not available, we're happy to talk to you, and we're also happy to talk about any of the portfolios you might be interested in, and we're also happy to answer any of your questions as well. Oh, and I've seen one already coming in, particularly about where we're available. So we would love to be available at Vanguard. Vanguard is known for offering its own products. And so they I don't know. It would be interesting if Toppler, if you're at Vanguard and you made a request, they would probably call us, or they could add our mutual fund. It would be interesting to see that model isn't one for being an open architecture. So when you are investing at Vanguard, they commit to low fees and basically a full market exposure for most of their products. And I'll be I'll be curious what happens, and we're happy to facilitate any of those conversations as well. I want to take time to thank our current investors for showing up, for our prospective investors, and then also just those people that are curious to learn about what does it mean to do impact in public equities? What does it mean to bring a gender lens to everything that we do? What does it mean to change the face of finance while we're looking across traditional Wall Street companies, and how can we build portfolios that are different, that are going to get us to the next just and sustainable economy. So thank you for joining us. We'll stay on a few more minutes in case there's any more questions, and if not, we'll give you back the rest of your day, and hope that you enjoy the rest of this short week.
We have a question on benchmarks. A slide earlier showed our fund performance against a marker. We specifically looked at the MSCI ACWI IMI, which is a global index. Do you also offer comparison against S&P or any other major indices?
Yeah, so that's a great question. The portfolios that we showed are global, and so we are going across the globe to get those. And the S&P, as we know, is the 500 largest companies, and so we'd be happy to do that. And yet, it's not. It's a little bit apples and oranges because the S&P is largely our 500, our meaning U.S. 500 largest companies, and we are cap size agnostic, meaning that we are really focused on the solution and the growth prospects rather than the cap size. And so we are actually love investing in smaller cap companies and then being with them and helping them grow and watching them grow, and mid cap size companies as well. And then, of course, we are looking for solutions across the globe and not focused solely on the U.S. Additionally, our revenues, well, this is true for some S&P companies as well, though we are really focused on having a diverse set of revenues. And that's one of the reasons I would say some of our outperformance comes from being really mindful of which countries our revenues are coming from, and that's a very diverse. So at any rate, yeah, be happy to share that, although it's not, it's a little bit apples and oranges.
Okay. Thank you, Kristen. Our next question is, I assume you're not considering nuclear as a favored alternative to oil and gas, from Leigh Peters. I can jump in and then have Kristen or Jethro chime in as well. We have talked about nuclear. In fact, this is quite timely because of the recent executive order on nuclear energy. We've been having these internal conversations as a team for a while now. Some of the publicly listed companies that are available to us that are working on nuclear technology and production of nuclear energy are on paper. They're still on paper. Essentially, they're still quite a few years away from actual production at scale. We have held back on those opportunities and haven't really invested yet because we are waiting to see how that conviction in nuclear as a clean form of energy plays out. The process of reactivating some of the dormant reactors that currently exist in the country is actually quite environmentally intensive as well. So currently we're focusing on viable sources of nuclear energy that are available, up and running, such as solar and wind, but we are keeping an active eye on the technology around nuclear that is developing. Kristen, Jethro, would you like to add anything to that?
Thank you, Sempar. That was pretty comprehensive.
Thank
Jethro.
you. And our next question,
Okay.
Sorry.
No, go ahead.
Just Our next question is, could you please speak to shareholder voting and advocacy a bit, and how these opportunities play into impact?
Sure. So I can jump in a little bit, and then also just to let you know, we do have past webinars, and we're doing another full webinar specifically on that topic because we do so much there. So, and it is one of my favorite things to talk about. So let me just do a little bit now, and then we'll invite you to visit a past one and then to our upcoming one. We also have an impact report that we'll be releasing in probably Q3 that will have a lot of that, and then I would say some sample case studies that we've done as far as both successful and then ongoing engagements are on our website as well. Though I'll just say one thing that makes us pretty unique is that we do seek to engage with every company in our portfolio over time. And starting with, we do vote all of the proxies. We seek to vote all of the proxies across as part and parcel, not just part of what we do. It's not a paid extra or on the side or maybe, it's an actual commitment. And we take it pretty seriously. So we do see that investors have both a role and a responsibility to be engaged in their companies. And we use that as both a way to move companies forward. We have in our firm quite a bit of expertise on the environmental side, particularly on the social side, and then also on the government side. And so being able to share best practices with our companies, we're really seeking a win-win relationship where they're very good at some of the things they do and then maybe could need some support in some other things. And so we, with our partners at Whistle Stop Capital, often benchmark what might be happening across whether it's the US companies or European companies or a certain sector of companies. Say if we're talking to a healthcare company, what types of disclosures we're wanting to see, where we feel like they could enhance disclosures. And one of the things we've become known for is particularly looking at human rights and employee rights. And in the process of having companies and large corporations be able to build and nurture that really strong human capital and that workforce that I was talking about earlier that is so important. Also, a moral obligation in the business side would say we really want outperforming companies, and we know that strong people practices do that. And then there's also a moral obligation to really have an end to discrimination at the corporate level. So we're doing both of those. And one of the things that we've become known for across that is addressing concealment clauses. So concealment clauses are just that Band-Aid that can cover up any types of discrimination, be it on a gender side or on a race or ethnicity side, even disability side. And so we are looking to have more transparency, and we have had some particular wins having large and small companies remove the use of forced arbitration as well as NDAs. And there's a write-up of our work at Apple, which removed NDAs in their employee contracts based on our work. And I believe that's on the website. Anyway, Laurel, this is one of my favorite topics, and so please tune in to our next in our next series of webinars, where we'll be addressing more of that in detail. I'll just add one more point on that, though, that in these conversations, we learn so much because, of course, we're asking questions about earning calls, and we're asking questions about forward earnings and sometimes cash flow, and sometimes we're asking about new products or services or intricacies of what they might find material. We're also adding these questions about reporting on scope emissions or about hiring practices and recruiting practices, and the list of questions that we ask is pretty in depth. And so seeing how the companies are prepared to answer these, they're not prepared, how open they are to thinking about them, whether they want to get a team together, whether they're open to our research, that really does share a lot for us. And it's a different way to do due diligence than you could get from a Bloomberg printout or report. So it certainly enhances our process. And we hope that we're seeing that it enhances the process for our companies as well.
Thank you so much, Kristen. The next question from Sunny is, solar stocks recently had not been doing well last year. How do you manage the balance between maximizing return and ecological concerns? I love this question, so I can chime in, and then I'll have Kristen and Jethro join in as well. I think we could do a whole other webinar on this because this is something that we're constantly discussing as a team. The whole basket of solar stocks have experienced both a number of headwinds and tailwinds, challenges and opportunities in the last couple of years. With when interest rates were increasing, the cost of borrowing was going up, and that impacted a lot of the solar companies. And then, of course, with the IRA, or the Inflation Reduction Act, that came into effect, I think about a couple of years ago now, that included a lot of incentives for these solar companies. So that was a critical tailwind for a lot of these companies. When we're looking at companies that address our solution theme, in this case, it would be Sustainable Planet, we're not just looking for a company that addresses the solution theme, but we're looking for a company that is best in class amongst those companies that are addressing the solution theme. So where we have positioned ourselves in a way that these companies have not been impacted to the extent that headlines would tell you they would be impacted by. So, for example, we have companies where a lot of their supply chain is vertically integrated in the US, which means that they have not been impacted by tariffs and therefore have not done too badly. We also have companies that have pretty significant exposure to international end markets. So even though there have been regulatory volatility within this space in the US, and that has impacted some of the solar stocks, our companies have continued to see a pretty robust increase in demand, and even up till the most recent earnings report as of Q1 2025, and therefore have not faced the brunt of the tariffs within the US. And lastly, we also are positioned in companies that are more on the utilities facing side versus the residential. This has also been a benefit to us because companies that have more of a utilities customer base have not experienced the brunt of the increasing interest rates as those that are primarily residential. So those are a few factors that we're thinking about. And as these trends evolve, our positioning of these different types of solar companies will evolve as well. However, overall, we have really strong conviction in the unit economics of solar and its long-term viability in addressing some of these power demand challenges. So we will continue to be in this space.
And Sunny, just to go on to that, I think you know too, we are long-term investors as well. So we are not traders where we're not going in and out of companies. We are looking for long-term buys. And so just one, there are some companies right now in the solar sector that are actually underpriced. That's based on a long-term horizon. So there's a lot that goes into that. And of course, also the diversification that you see. So we're not just in the renewable energy sector. That's one piece or one basket within a larger portfolio.
And I'll just add just one final note on solar is that
Yeah.
this is what we put on the stewards of capital hat and always try to balance risk reward. So just to both Kristen and Semper's points, we've been able to find and invest in a particular solar company that trades at a 50% discount to the market, has double-digit revenue growth, and it's far and away, one of our best performers of the year. So we can find opportunities in the space.
Thank you, Jethro. Nice point there.
Just want to point that out. Yeah, they're
I'm
not all bad.
seeing another one from Abby too, just about shareholder activism. And I think it's worth reiterating because a lot of the press we get is on our, I'll just say it, bold and maybe courageous work at Tesla. And yet we don't hold that in client portfolios. And so what happens? So we are not the firm that goes after, and I often use Chevron as it's an easy company to pick on. But we're not the type of company that picks on, or excuse me, that would hold a company like Chevron. And the reason I mention it is because its core business model is the opposite or the antithesis of what our solutions focused themes would be and where we need the economy to go. So we're not looking to hold a company whose revenue comes from something that is extractive and damaging to communities of color, to our climate, and then go after them and say, hey, we'd like you to clean up this business model. We'd like to turn this ship around, and we'd like you to diversify leadership on the way back. So that's actually not what we do. And so with Tesla, we actually went into them, and somebody else asked about battery play. That was when I first identified Tesla, and back when I was first building this portfolio in 2012, very early on in the Tesla career or the Tesla trajectory, it was that battery play that I was most interested in. And, as we know, and many of you have heard me say that, that company, whether it's the CEO or whomever, is has disrupted, our entire automobile industry as we know it. And yet the reason we were really interested in that company was about the battery play, and then particularly with the solar coming in and being able to get off the grid completely. There's a lot there, and there's so much potential. And yet we saw a really significant issue with governance, with the executive team. For all of our companies, we do need the CEO to report to the board, and that is not what happens at that company. There were environmental concerns. The concerns were huge, and yet we had met so many employees that I'd met with over the years who had suffered discrimination. And so while, as Jethro mentioned, we're very much looking out for clients and risk, and we knew that we had to remove it from client portfolios based on the risks we saw, particularly to shareholder price. As well as to some of our other concerns. And yet we held a little bit of it, and we moved it over into what we call this activist portfolio so that we could continue our work. And that means that when you hold shares, we can file resolutions, we can ask for meetings for the board, and holding those shares allows us to be able to do that work. And so we will continue that work at Tesla. We actually got our first significant win after over 5 years of engaging, where we got a commitment this year in the 10K where the board said that they would oversee human capital management, which is something that we've been asking for a long time. So again, we'll continue with them. And yet, unless we see environmental, social governance prospects that we're really excited and proud of, as well as financial prospects and growth prospects, you won't see that in a client portfolio anytime soon.
We have another question from Lei. Is Tesla still considered the leading actor in battery innovation? I heard from someone that they have been overtaken. We also have a follow-up question from Sunny. Long-term investment as in 3 to 5 years, 10 years, or longer?
Yeah, so we're looking at what's called, quote unquote, a market cycle, which is 3 to 5 years or so. And then just as far as what we would hold a company, so we're not looking to cycle through companies. We are looking for the very best solutions that are needed for people and planet, and then what will the market reward for. So as long as a company is continuing to innovate and continuing to show signs of growth and continuing to really strengthen their environment issues, whether it's commitment to sustainability. Usually we are seeing that through their very core business model, through the products and services. So generally, and this is true for all of our companies, as they grow, their positive impact grows. So that's something that we're looking for consistently. And as long as companies are showing that they are making positive progressions, they could stay in our portfolio indefinitely. We're not looking to say, okay, we've held them for 5 years, we're done, and we're moving on. Now, it is all based on conviction. So just to go into Lee's point, as far as where is the battery innovation and where is that happening, both on the electric vehicle side, as well as on batteries, and then also on solar roofing, our convictions will change as, in the case of Tesla, we see them not keeping up, and others are coming in to replace those. So then we do, every time we talk about a company, we talk about the peers, we talk about what are other places, what are other potential companies that we think are better valued, better priced, that might now have a technology or innovation that is really keeping up, or maybe even better than what we had before. So we're constantly refreshing in that way. No, we can stay on for a little bit more just in case there are questions. And if not, I'm just going to say to everybody, thank you so much. We love sharing our work. We love all of your questions. Your questions make us stronger, and we love diving into this. So, and if you have ideas or suggestions for what you want to hear in additional webinars, I mentioned that we are going to be going into more trends, and we're also going to be going into our shareholder activism more in depth, both as a right and a responsibility as investors, and anything else you want to hear from us. We really welcome your feedback and your partnership. And so please do send in your suggestions, and we look forward to sharing anything more with you over time. Please do stay in touch.